After a year like we've just experienced, it can be hard to feel optimistic. Whether we're looking for them or not, the negatives just seem to be everywhere. Finding the positives in the midst of all that negativity can take a little effort and perhaps even a bit of imagination. But history tells us that they are indeed there if we look hard enough. And since markets typically bottom long before the news cycle turns, we know that as investors, we'll be too late if we wait for someone to ring the proverbial all-clear signal. To be clear, we nor anyone else knows if stocks or bonds have bottomed yet. We hope they have. But as you may have heard me say before, hope is not an investment strategy. When it comes to investment strategy, ours is driven by valuations. And when we think about positives for the year ahead, this is by far number one on our list. The price declines of the past 12 months translate to valuation levels for both stocks and bonds that for the first time in well over a decade appear reasonably attractive. Attractive valuations aren't always sufficient on their own to push markets higher though. So what are some of the other positives for investors to hang their hats on as we head into a new year? The biggest fear surrounding 2023 is the threat of recession. While the risk is real, if we have a recession, it will likely be the most anticipated recession ever. One of the key dynamics behind recessions and related market sell-offs is typically the element of surprise. In this case, the bar has already been set incredibly low, likely removing some of the sting if it were to happen, especially if a recession is either short or mild. While the Fed is expected to continue to increase interest rates in early 2023, they are nearing their terminal rate, or the point at which they'll likely stop raising rates. Given the negative market impact the rate hikes have had to this point, the end of that cycle would likely be a welcome development for investors. Of course, inflation will be the driver of what the Fed does. Fortunately, we are seeing signs of deceleration in several important inflation components. Things like shipping costs and commodity prices have cooled significantly, and there are signs of labor and housing markets softening. A continuation of those trends would go a long way toward easing investor fears and ending the Fed hiking cycle. Looking closer at the economy, while growth is generally expected to slow, there are some components that could shift from growth detractors to growth tailwinds in the coming year. The first one being housing, which has already felt the impact of higher interest rates with existing home sales having dropped to their lowest levels since 2012 and new home sales back to 2017 levels. As rates stabilize, activity is likely to pick back up. The second is industrial production and specifically autos, as supply chain constraints are easing. With auto inventory still 33% below pre-pandemic levels, there is considerable room for production to ramp up. Our last positive is one based on past history around election cycles. The year following midterm elections, as 2023 would be, has historically been the strongest year for stocks in the 4-year presidential cycle, and over the last 90 years, stocks have had a positive return in 21 of 22 such years, with the start of World War II being the only exception. We all know there are plenty of current headwinds for markets, and frankly, there always will be. There are also plenty of potential positives, and given what we've all endured over the past year, we thought it was time to look at some of those positives, and hope you agree. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this video.